Hey everybody, good to be here. My name is Brent Moore. It's time for Long Options. We do this each week at this time. And today I want to talk to you a little bit about anticipating flag breakouts. So we're going to talk all about flags today and long options. We'll get to that in just a minute, but just a reminder, I'm joined alongside by Connie Hill in the chat, who's helping me out. And so you can follow either of us on X at Brent Moore CS, at Connie Hill CS. And good to see some familiar names in the chat. And those of you who are watching and are brand new, great. Or if you're watching on a recording, that's great too. Let's go through some disclosures. Options do carry a high level of risk and are not suitable for all investors. And the information today, that is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. The paper money application, that's what we'll be using today, is provided for educational purposes only. And we'll be looking at individual symbols and trades, but these are all examples. None of these are recommendations. All investing involves risk, including the potential loss of principal, and past performance of any security or strategy does not guarantee future results or success. There we go. Let's head on over to the Thinkorswim platform. This is the market right now. It's basically break even for the day. So we've had a pretty strong run up. And one thing, let me just zoom in a little bit. This is the S&P 500 here. One thing is you look at this, look at the S&P 500, you can see, we kind of ran up and pulled back and ran up and pulled back and ran up and pulled back and ran up and looks like we're pulling back. Now, it doesn't mean that it's going to go up in the future like it's done in the past. All good things come to an end perhaps. But this is kind of a typical pattern that we often see in the market, both to the upside or the downside. Look, I could do this to the downside too. We could say, it went down and pulled up and went down, and like that. And so these are kind of representations of flag patterns. So I want to talk to you about what a flag pattern is to start out and how to find them and potential trades with them. Okay, so let me do this and just kind of mention, I already actually kind of gave you a brief overview of what a flag is, but let's do this. Let me just pull this over right here. And why we call it a flag, I guess, is a question. And so in the context, sometimes we'll talk about bull flags, okay? So flags can be bull flags, or they can be bear flags. Okay, I'm just going to write that. That's supposed to be bear flags. Sorry, it's a little hard to write with this little drawing tool I have sometimes. Bull flags typically are going to be in the context of an upward trend. Upward trend. Okay, and just put T, upward trend, and bear flags in the context of downward trends. And so with the bull flag, we have this upward trend, but when it goes up, we'll have some candles that go up. And then what happens is typically we'll have some candles that go down or sideways or something. But these candles that go up, we can form this, what we call flagpole. Okay. That's our flagpole. It's kind of like you can envision out in out in front of a post office or something. Maybe there's a flagpole. It's kind of leaning over a little bit. And then this is the flag right here, where it goes down a little bit. And you can kind of envision this is kind of like a flag. And then at some point, what we look for is a breakout above here. Okay. Now, sometimes what we'll do is we'll enter on the breakout. But you know what else you can do? You can actually enter in anticipation of the breakout, or set up a trade, I should say, in anticipation of the breakout. Now, you can't enter in anticipation, of course, but you can even set up the trade, not enter until the breakout occurs. You can do that ahead of time, and that's what I want to show you today. The same thing is true on bear flags. Bear flags, the trend is down, it goes down, then it goes up, and then we look for this area where we start to break down again. So that's what we're looking for on flags here. And often what you can do is you can just kind of look at a list of stocks. You can just look at the S&P 500, perhaps, or the S&P 100, or the Dow, or whatever list you want, and try and just kind of look at the stocks. And this is an index here we're looking at, but you can just kind of look at the stocks and look for those flags. Here's the flagpole. Here's the flag. And here was the breakout right there. Here's the flagpole, new flagpole. Here's the flag. Where's the breakout? We don't have it yet. We may get it, but we don't have it yet. Okay. Now, it's easy enough just to scroll through stocks and look for that. It's a relatively recognizable pattern. But I did a session a few weeks ago, to be exact, on May 20th, where I talked about how to scan for flags. If you want to use the scan tools here on Thinkorswim desktop, scan, Stock Hacker, I created some scans in that. Those scans I actually posted on my X account today, okay, at Brent Moore CS. I did a bull flag scan and a bear flag scan. And if you save those, what they'll do is, if you can bring them up as a watch list, and then you can just kind of go through the list here. Now, as with any scan, they're not perfect. You're going to see some results and you go, I don't love it. It's almost like as if you were house shopping. Let's say you're house shopping. You put the parameters in the search and it gives you a few homes to look at. Does every home you walk in and decide, I want to buy this, meet exactly what you want? No, not exactly, but it narrows it down. That's what the scan does. It narrows it down. So these are just idea generators here for you, these scans. This is the bull flag scan. Given what the market has been doing lately, that is going up for the most part, there's a lot more stocks that come up with this bull flag scan right now than the bear flag scan. But the examples I have here today are examples from these lists here. But one way you can do it is you can just kind of go through and look and see, I like it or I don't like it. That's certainly a fair way to do that. And then you got to decide, is it giving me a breakout right now or not? Here's Citigroup, okay? Let's look at Citigroup for a sec. Now, big caveat on this, Citigroup has earnings coming up. I'll show you that in a sec. But you can see this one actually has some really big flags. It went up, it kind of flagged down, broke up, kind of flagged down, broke up. Looks like it's flagging right now. Do we have a break yet? No, we don't. But we can put in a trade in anticipation of a break and only get in when the break actually occurs. There's that earnings. For the most part, my examples today, I'm going to try and avoid earnings. You don't have to avoid earnings, okay? A lot of traders just view that there's extra uncertainty with earnings. Now, it may go your way. It may go against you with earnings. But a lot of traders just try and take that variable out of the equation. Well, if you go to MarketWatch, here's MarketWatch, okay? Here's MarketWatch. And this is just S&P 100 stocks. Okay, this is just S&P 100 stocks. I have the link for both the bull flag scan and the bear flag scan. I posted it today. Today is July 8th on my X account. Okay, I have them both posted right there. Here. So here is, and Connie, perhaps you could help me out and post those, repost those in the chat for us as well. So sorry, I don't have the link available right now. But here we go. Here's stocks coming up, and with earnings, a lot of financials. This is earnings season is kind of kicking off July 18th, and you can see others as well as you go down the list. A lot of companies coming out with earnings here, so that's going to be an impediment. So I'm going to kind of avoid a lot of these right here right now. I'm going to avoid a lot of these right here right now. I thought I posted it. You guys can't find it? Let me, I'll post them. If you guys can't find that, if Connie can't find that, I'll post it in the chat here in just a little bit, okay? And I'll double check and see why. It should be about the third one down on my list, I would guess. Okay, but let's look at this. Here's charts. Here is Disney, okay? And this is one that came up on my, well, you can see it right here. It's on the scan. Earnings. This does not have earnings for a little while. It has earnings on August 6th. August 6th. So that gives me a month, essentially. Well, this isn't, we're not planning on being in this trade for that long. I'm going to zoom in just a little bit here, just to take a look at this. And let's just see if you can visualize the scan, okay? Let's visualize a flag. Remember, flagpole goes up, then it pulls back like this. Goes up, and it pulls back like this. Goes up, we're in this process of it pulling up. Now, there's a couple ways to do it. One, you can just kind of visually look and say, oh, look, if this hits, say, 125, I'm going to get in this trade, okay? 125, I'm going to get this. That's one way to do it. Another way is to use something that we call, for a bullish scan, a hold. And that is a close above the high of the low day. In other words, we're going to look for a low day. Well, this is the low day, okay? Okay, here's the low day, right there. This is lower than any day we've seen recently, okay? That's the low day. We're going to look for the high of the low day, which is today's high, which is right there, okay? That's that. That's today's high. And we're going to look for a close or at least a move. Maybe not a close, but a move above that price. So I'm just going to jot down that price here real quick. That was 123. My pen is not working. 123.71. Okay. So let me just double check. Let me get out of here. Remember, you can just scroll over the day, okay? And this will give you right up here, it goes open, O is open, H is high, L is low, C is close, R is the range for the day. That's the difference between the high price and the low price. And Y is what price value I'm pointing out on the Y-axis right now, okay? But I care about that high. So I want to get in there. We're doing this in anticipation of Disney bouncing up. What if Disney doesn't bounce up? What if Disney just starts to go down like this? Then we're not going to enter that trade. Now remember, there's different types of trades. This is a bullish trade. This is going to be a call trade. But we can do a call swing trade. We could do a call trend trade. We can do a call long-term trade. In this case, I'm just going to do a swing trade. Where's my target on this? I'm going to set a target because it's a shorter term trade. And there's different ways to come up with targets. One is you can look for resistance areas. Number two is you can look at the length of the flag, okay? So let's do this. I'm going to draw a line. Let me do this. Let's do this, okay? I'm going to go from low to high. That's my flagpole, okay? This is going to be a long call. Yes, this is going to be a long call. I'm going to right-click on this line I just drew. I'm going to duplicate that, and I'm just going to move this right here, okay? And I'm going to anticipate another move that's similar to the past move. Any guarantees on that? No guarantees. This move down here, which we had, that was a flag pull. Was that going to be exactly equal to this one? Probably not. But that's kind of how we're estimating the target. There's no guarantee we're going to hit that target exactly. That's about 131.5, okay? 131.5 is going to be my target. Okay. So we're only going to get in if we get the close above the high of the low day. That's going to be our target, and we're going to set a stop. I'm going to set a stop 1% below today's low, okay? Now, remember, when I look at this stop, initially it's going to look like a very, very, very tight stop. But keep in mind, this isn't even going to be valid unless the stock bounces up. We're not getting in right now. We're not getting in at 122.05. We're only getting in if it goes up to 123.71. I'm going to put my stop 1% below the low price of the day. Okay, 121.97 is the low price of the day, 121.97. I'm going to multiply that by 0.99. I'm just using a calculator here for that, okay? So my stop is going to be 120.75. Okay. If you have any questions on that, let me know, okay? We came up with our entry. We came up with our target. We came up with our stop. Fair enough. And I'll show you how to enter a long call on that. This is a shorter term trade. Keep in mind, some traders may be trend traders. And they may say, look, I still want to get in using this flag. Okay, you can use this flag to enter swing trades. You can use this flag pattern to enter other types of trades. If I'm doing a trend trade, I may say, hey, look, this stock has generally been trending up. Okay, it's been going up. In fact, I can even throw on some moving averages there if I want. There's my moving averages. As long as the stock is trending up, I'm going to continue with this trade is one approach to this. And that means even if it goes up in flags, even if it hits a target or whatever, I'm not going to change on that. But right now, what I'm going to do is I'm just going to do this as a swing trade. By the way, everybody, there's a survey link in the chat. We appreciate your feedback. If you would fill out that survey, one thing you can do in the survey, you can always give me suggestions for things you want to see covered. Obviously, they need to be related to this class, okay? Long calls or long puts this is a long options class. Can't do futures in this class. I'm not doing covered calls in this class. But if you have suggestions for future topics, feel free to type those in, okay? So there's my trade. I'm looking for I'm anticipating, because it hasn't occurred yet, the flag breakout. And for that, I'm going to use that close above the high of the low day. So here's how we're going to do the trade. First of all, what I want to see is how long, I'm going to kind of anticipate here. How long am I planning on this trade to last? Well, the last trade lasted, 6 days? Okay. This one from here to there was probably 2 to 3 weeks. So I'm going to expect at least a couple weeks. And if I'm expecting the trade to last at least a couple weeks, I want to give it more time than that, because maybe I'm wrong and maybe it takes a little bit longer than that. And I don't want to hold this all the way down to the bitter end. So I'm going to take whatever my time frame is, and I'm probably going to add a couple weeks onto that. So I'm going to be looking out 4 weeks, maybe 5 weeks for this trade. Okay. So here we go. Let's do it. Let's go to trade. I'm going to Disney. I'm looking for expiration dates, 4 or 5 weeks out. I can go out to, that'd be like 3 weeks. I'm going to go out, we'll go out at least to August 8th. Now, I can look here and I can check for liquidity on the trade. Make sure our bid-ask spreads are okay. I can look at my open interest. If that is a concern, I can go to the weekly contracts. That's 38 days. That's a little bit more time than I need, but you're going to notice a lot more open interest here on this trade. I'm also going to go, at the money, maybe just a little bit in the money. I'll go to the 120 strike, and I'm going to right click on this trade, and I'm going to buy custom, and I'm just going to say with stop here. Okay. Now, we said we're only going to get in this trade if it goes above 123.71. So what I'm going to do is, let me just shrink this left side down here. I'm going to make this a market order. I'm going to make it a good till canceled order. And I'm going to click on the little gear. little gear on the right. And I'm going to say, I only want to get in under these conditions right here. Disney marks greater than or equal to, come on, 123.70. I said 123.71 would technically equal it, so I'm going to go just a little bit above it, 123.72, and we're going to save that. That's my anticipatory trade in anticipation of the bounce. We're not getting in right now. Now, I'm also going to sell out. I'm going to do the same thing. I'm going to make this a market order. I'm going to make this good till canceled. I'm going to click on the gear. And on this one, we said we're going to get out if Disney marks less than or equal to our stop, which was 120.75. That's why I write these down, by the way, everybody, because I couldn't remember that. Otherwise, 120.75. Or I'm going to click on the line below if Disney marks greater than or equal to our target price. Our target price was 131.50. 131.50. Now, one thing, let me click on save. One thing I would also mention is if I click on confirm and send, now this is just one contract. How much can I lose on the contract? Yes, I do have a stop, but keep in mind, options are volatile and you can lose the entire amount of the transaction. So these are a more, long options, long calls, long puts are more, it's a more aggressive form of trading, okay? So this is a leveraged investment. But one thing I want you to consider is this. Our first order, we're getting in at 123. I'm just going to say 70. I'm rounding just a little bit. Our target, if we hit our target, is 131.50, and our stop is 120.75. Okay. If you're concerned about it like a reward to risk ratio, what you may do is look at the difference between your entry price and your target price, and then look at the difference between your entry price and your potential stop. Doesn't mean we're guaranteed to get out at this price or any price, but just kind of looking at this as a reward to risk kind of on the stock. It doesn't necessarily translate to the option. Okay, options are a derivative, but that is something where most traders like to keep that a positive ratio. In other words, a bigger distance between entry price and target versus entry price and stop. Okay, so there we go. That is the trade. What I'm going to do is I'm going to put that in our long single options bucket. We're going to click send, and it's not going to fill because we haven't had the bounce yet. Okay, any questions on that? Let me know. Otherwise, I'm going to move on, and I want to look at another one with you here. Let's look at something that's a little more bearish. Okay, so this is just a bearish example. So this is going to be more of an example of a bear flag. And let me zoom in a little bit here. And what you can see is Adobe had a pretty good run. Okay. Again, this is a trade that was off the scan that we shared at the beginning. It had a pretty good run, but things have kind of changed. It peaked out with a high here, and then subsequently we've had a lower high. The lows kind of got higher, but subsequently we got a low and then a lower low and a lower low. It appears that this trend has reversed itself here. Now, again, what we can do is we can say, well, I want to use moving averages to help me out on this. Well, I can look at my moving averages. In fact, we just had a moving average cross on this. Excuse me. The 20 crossed below the 50. Now, that's not a specific recommendation on exactly what moving average links you should use, but just as an aside, traders will often use a moving average crossover as a way of kind of indicating bullishness or bearishness. When the shorter term moving average, in this case 20 in red, crosses below the longer term moving average, that is often deemed to be a bearish signal. Same thing on the other side. If the 20-day or the shorter term moving average crosses above the longer term, in this case a 50, that would generally be deemed to be more of a bullish signal. okay? But in this case, that's kind of the justification on this. Now, if we're looking at a flag, remember, bear flags are this: high to low, and then a flag, okay? And then a breakdown. This is a much smaller one, and then a flag. We're only going to get in, okay? We're only going to get in if we break the flag. If I'm looking at this, and I'm going to zoom in a little bit again, just to make it a little bit easier to see, okay? We're only going to get in if we break this flag here, okay? And so I'm going to look for a close below the low of the high day. Right now, this is the high day. This is the high that we've reached. I'm going to look for a break below here. Bearish trade, remember, this is a bearish trade, below here as a potential entry. Well, the low price on that is 377.18, 377.18. That's going to be our entry. And I'm going to look to get in. Now, before I mentioned, we can do swing trades, which we demonstrated on Disney, but you don't have to do a swing trade. You could do a trend trade. I could say, well, look, this, maybe I have other reasons. Maybe I think this is going to continue to go down for a little while. And in fact, maybe, this latest flagpole, which is often where we'll do our target, that's not a real long one. I think the trend is going to continue down, though. And maybe we have some resistance down here where our old lows were. That's a ways away. We're going to let this run. How long is it going to take? I don't know. It's probably going to take, if things go as planned, it's probably going to take more than a couple weeks, though. So I want to buy more time on this put. Furthermore, I'm not even going to put in a target price on this. Now, I could say, well, my target's going to be down here. I can do that. Or I could just kind of view this as a trend trade. And as long as the stock continues to trend down, we're going to stick with it. Okay, that's the theory on this. And what we're going to do is we're going to put a stop in case things break against us quickly. Doesn't guarantee exactly where we're going to get out, but hopefully it helps to protect. And if at any point we're looking at this and we're saying, no, maybe our stop hasn't triggered, but it's not looking like it's going down anymore, maybe we'll get out of that trade. If the trend breaks, we'll look to get out of that trade. I'm going to be looking at, say, the 20-day moving average as a kind of, my sign. Our 20-day moving average is sloping down. We're down below that. If we look up and the stock is, goes like this, and we're breaking above that 20-day, then maybe we'll just say sayonara to the trade on that. But that's what we're going to do right now on this one. So we said this is probably going to take a few weeks. So I'm going to buy a little more time on this, and I'm going to look at puts on this. I'm probably going to go out beyond the 38 days on that. We'll go out 70 days. So I'm going to go to the monthly options. 70 days. That's probably more than we need, but we can buy a little bit more. The consequence of buying more time means it's going to cost more. It's going to cost us more up front. However, presumably, there'll be more time value along the way, and that should help give it more value along the path. Now, it can still go to zero. One other benefit of buying more time is the rate of time decay, theta, will be typically significantly lower if you go out 2-3 months than if you just go out a month. So that's one benefit of it. That's not the only factor. If I wanted to just trade and minimize theta, then I would always go out, as long as possible on these, because that's your rate of time decay is going to be less on these. But there's other factors in there here, including total risk on this. Because the more expensive the option is, if I do this, I'll go out to January or December 2027, and I do something at the money, this option here is going to cost us about $6,000. Well, that's not really what I want to do right now. So I'm going to go here. I'm going to go to my puts. Again, I'm going to go at the money, maybe in the money just a little bit, Remember, this is a put, so in the money is going to be this side of it. So I'm going to go 385. 385. And I'm going to right click on this. I'm going to buy custom with a stop. Now, we said we're only going to get in if the stock goes below 377.18. So I'm going to click on market. I'm going to click on GTC. I'm going to click on the gear. We're looking for Adobe to go mark below, less than or equal to 377 point, I said 18. I'm going to say, well, I want it to go below that. So I'll go 317. Okay. So I'm going to click on save there. Okay. So there's my entry on this. I'm only getting in if we get the bounce. Yes, this may look kind of bearish, but there's always this chance this thing just kind of continues to go up from here. So I'm looking for confirmation on this trade. That's what we're looking for here. When are we going to get out? Here's what I'm going to do. I want to show you a different way of potentially getting out. Before, we demonstrated getting out if the stock bounces, say, above the high, putting a stop above here. We could go above this high price if we wanted to. I could take this price, this high price we just hit today, go 1% above that. I don't know exactly what that'd be, but you can figure that out and say, I'm going to get out at that point. But another way of doing it is actually putting a true stop in on the option. Okay. So what I'm going to do here is I'm going to put a stop in on this option. Based on the option price, let me just kind of see if I can make this a little bit bigger. Stop, and I'm going to put this in. I'm just going to change this to trigger, and I'm going to say, well, okay, let me do it this way. Okay, so this is a stop. You can do it as a percentage if you want here, or you could do it as just a value here. In other words, I could say I'm getting in for X dollars. Say, I don't remember exactly what it was, but let's say $5. Okay. I could put in the stop and say, I'm going to get out at $2.50, okay? Or maybe 60%, $3, okay? But one thing is this, is I'm going to put, we don't know exactly what price we're going to get in at yet, right? We don't know what price we're going to get in at. And therefore, because we're waiting for the stock to go down before we actually enter. Okay? So if I want, what I can do is, let me get rid of my drawing tool. Come on, get out, go away. I can say, I'm going to put this in and make it a percentage, and then this will put this in after we have an entry price on this. That way I don't have to try and anticipate what the price would be. Now you can anticipate, there's ways to anticipate, and I'll show you how to do that in a sec. But that's how you can put a stop in based on the option price. Confirm and send, and I'm going to put this in our long options. Make sure you read all the red stuff down here. And remember, stops aren't guaranteed, and we could put that in there, okay? All right, now, let's say you wanted to try and anticipate what price is this going to be if the stock goes down to, what did we say, 377.18. You can always go up to here, switch it to Theo price. Let me just zero this out here. Let me reset that. And we can say, well, what's the price going to be if the stock goes to 377.18? Well, that's down about $4. So I'm going to put in a minus sign, $4, 377.51, and I'm going to just make this 377.18. Okay. Now, it depends on how many days pass. The price of options change day to day. So I'm going to say, well, let's give it a couple days before it does so. Today is, that is not right. There we go. We'll just say tomorrow. Okay. What's our price going to be? Well, let's see what we got. We did the 385 contract. The expectation is the price, if the stock goes down, would be about 24.31. Okay. Do you see how I did that? I went to Theo price here. I then altered the day. Here I only went out a day. The stock price to meet the entry price. Okay, to meet the entry price. And then I can look at this Theo price column and kind of anticipate what price that is. And then I could set a stop up there if you want to do it that way. Okay. All right. Now, let me do this. There are scripts in the chat, or there's scripts on my X post. Okay. I already told you where to get those. It's on my X post. It's on July 8th. What do you do once you get those scripts? If you don't know, this is what you do. You copy the script, first of all. You copy it. Then you go up to the little gear in the far upper right portion of your Thinkorswim platform. You click on Open Shared Item. You then paste that script right in there. Paste it right in there. You can click on Preview. It'll probably ask you to name it, and you can name it Bull Flag Script or Bear Flag Script or whatever. And then you click on Import. This is a script for a scan. And remember, scripts aren't guaranteed for accuracy or timing. Okay. But maybe you find it helpful nonetheless. Once you've imported that scan, it should save automatically, once you've imported it, to your personal scans here. If you're on Scan Stock Hacker, you can go here and you can load your scan query and look at personal. It should be listing there. Furthermore, it should show up as a watch list there as well that you can pull up under your personal watch list. All right. I'm hoping that is making sense, everybody. So here was Adobe on that Bear Flag scan. And by the way, this scan, as I mentioned before, you can see this, my May 20th webcast, we talked about creating these scans. This is just scanning the S&P 100 because the intention of this is options, and I'm trying to go for more liquid type options. But if you want to see more, you can change this to, instead of S&P 100, S&P 500. Scan again, it's going to give you some more possibilities there. Okay? So there you go, everybody. Now, another one that I'm not going to go through right now, but I'm just going to give you as an example, and you guys can practice this on your own in your paper money account if you like, is I was looking at Southern Company, SO, as a potential bullish type trade here, where the kind of the trades today are, the point of these trades today, these example trades are anticipation trades. In other words, we may say this is looking bullish. We may say it's kind of gone up. It kind of had a flag here. It's pulled back. I'm waiting for that bounce. Close above the high day would be, right? Well, there's our high right there, right where I'm drawing those little dots. So we'd be looking for a bounce above there. That'd be another possibility for the bullish scan. And of course, you can look through others. Now, some of these you're not going to like. I mean, maybe you look at Alphabet. Well, that looks like a nice little flag we're forming there. Some of these may not look so much that way. Here's JP Morgan. Remember, yeah, it looks kind of like a flag, but we have earnings coming up on that. Mondelez, nice little trend here on a lot of these. This one may be problematic, right? Because you may look at things such as, this seems like there's a lot of resistance perhaps right in that area, okay? So if we were to do like a close above the high of the low day where we get in up here, we'd be bumping up into resistance right there. So that would be one where you probably would be less likely to do if you were to follow these rules that we follow in this class. Of course, who knows? This could go way up, could go way down. I don't know where these, any of these are going. We just talked about technical analysis and using flags for that purpose. Now, one other thing before I wrap up is last week we did a trade on Starbucks. And we're down a little bit right now. We're down $55 on Starbucks right now on this, okay? This was a long call trade. We still have 24 days to go, so there's no super urgency to get out. We do have a stop on this, okay? We do have a stop on this, so it's, even though we're down a little bit, it's not stopped out. We may ask ourselves, are we still bullish on Starbucks? Well, let's look. SBUX. Yeah, I mean, you may have your opinion. If you don't think this is going to continue to go up, then you may just exit. This is a long call right now. But right now, from a technical standpoint, what I'd say is we potentially have some resistance right here. We have an upward sloping trend. That is an ascending triangle. And a lot of traders will deem that to be kind of more of a bullish pattern. Of course, we need the breakout. And if we break below here, that would be a bad sign for it, and we may look to get out right there at that point. Okay, so we're going to look to manage, but I don't see any reason to manage that trade that we put on last week. We also put a couple hedges on last week, for example, on the portfolio as a whole, but that's not something that we're going to take off either because they're a hedge, and they're not necessarily intended to make money. They're intended more to protect us in case the whole portfolio went down. All right, so what did we do today? We talked about what flag patterns are. We talked about doing trades in anticipation, entering the order in anticipation of a flag breakout, even if the breakout hasn't occurred yet. We're not entering the trade itself, but we're entering the order for the trade if the breakout occurs. We talked about doing that from a bullish standpoint and a bearish standpoint. We talked about bull flag scans, bear flag scans, and there we go. Okay. What do we have coming up next? We have getting started with technical analysis. That's coming up next. There's a survey link. Just a reminder, please fill out that survey, everybody. Thank you for joining me. We'll be back next week, same time. And thank you, Connie, for helping me out in the chat. Thank you, each of you, for joining me. We do appreciate your viewership. And thanks to Bree and Gabe and Andrew and all their help in production as well. So everybody have a wonderful rest of the day. Bye-bye.